Good afternoon and happy Thursday, everyone. It's Scott Wohlers with River Place Capital. It is Thursday, March the 9th, and just wanted to take a brief moment to discuss where equity markets did last week, breaking a two-week downtrend. The S&P 500 finished the week up 1.9%. On the week, the mid-cap index was up 1.83%, almost right there, and the S&P 600, the measurement of small caps, was up 1.9% as well. And so a positive week into the equity markets, but as we moved into this week, more volatility has crept into the marketplace. We're not getting as much corporate earnings. We're now relying more on economic data, and we had Chairman Jay Powell speaking this week in front of Congress. And on Tuesday, he gave some very hawkish comments, and that sent volatility back into the market and sent the market down. And the markets have been relatively muted since Tuesday, around the flat line, up or down slightly for the last 2 days. And everyone is waiting to see what the jobs report that we get tomorrow is going to be, because it has come back into the market that the Fed may actually go 50 basis points higher at this next meeting, where only 25 basis points were priced in. So as we've been talking about for the last couple of weeks, understanding that volatility is going to be a big theme for 2023, we thought it would be important to give a guide, an investing guide for how you can handle it, whether that's if you're a short-term trader, a long-term trader, or a middle intermediate trader. So let's give you some tips on how to navigate that. So if you're a short-term trader, think as very small as a day or two. Take losses very, very quickly. Put in limit orders on your orders and put those stops at very, very low losses. Same thing on the profit side. Take profits just as quickly. Put in limit orders on the upside as well to capture those profits. Think about it as if you were a piranha attacking your prey, taking little bites here and there. The other thing that's important is to stay in very liquid names, names that have a lot of liquidity, that aren't going to be as volatile intraday and on a day-to-day basis. For your middle-term investors, you don't have to be as short-sighted by any stretch of the mind. You want to stick to your discipline here. Look through the noise and the volatility a little bit. And this is where you want to stick to your convictions. Is that business or that stock that you own one that you believe has growth prospects over the next several years, regardless of the current stock market conditions? This is the time to evaluate your portfolio for that and make sure that you have those companies in your portfolio that you believe are going to grow over the next 3 to 5 years. Now, and think of this as reasonable returns, more like shark bites. So you get a bigger bite, but not the biggest bite, and you're thinking more on a long-term perspective. Now, for your long-term investors like us at River Place, the economic chatter and concerns of the moment are going to be fleeting. They're going to come and they're going to go. Look at this as an opportunity to get in at a discounted price for any excess capital that you may have on the side. Take advantage of dips in the market, but make sure, again, that you're still owning those names that are those quality names, those businesses that you have convictions that are going to grow over the course of the next several years. Be realistic about the current market conditions and your expectations as well, understanding that it's a long-term investment game. Warren Buffett just released his annual letter a couple weeks ago, and he said, hey, the key is starting early and live into your 90s. So understanding that time is on your side here, invest early, understand that there's going to be volatility on the short term. So that's just some ways that you can handle the individual volatility that you're seeing right now, and ways that you can take advantage of it. But I wanted to touch a little bit on inflation and maybe give a contrarian view to what the Federal Reserve Bank is currently coming out and stating. So you have Chairman Jay Powell testifying in front of Congress that in order to reduce demand on goods and services, we need to cut demand, and the only way that we can do that is with interest rates. With higher interest rates comes higher unemployment. But I have an other perspective, another view. We have an aging and retiring workforce in the United States, and we have a shrinking workforce. So we do not have as many workers working today as we did before the pandemic. So you don't have as many people producing goods and services as they were several years ago. So instead of continuing to shrink that workforce, what if we increased our workforce? Therefore, we could increase the output of goods and services that we can do that through. And so that can be done on a myriad of reasons, whether it's through legal immigration. That is a great way to do it, but there's a myriad of reasons to do that. But just wanted to give that contrarian view to what everyone is saying out there, that we have to have higher unemployment to bring inflation down, where we could attack the supply side with more employment and more jobs. So as always, if you have questions about what's going on with your individual portfolio or ways that we can help you navigate this volatility, call us. We're easy to talk to. You can reach us at 904-346-3460, or as always, check us out online at www.riverplacecapital.com. I hope everyone has a wonderful rest of your week. Thanks so much for watching.